Welcome back to the Traders Network. I'm Michael Yorba, your host. Thanks for joining us. We're also streaming to you live on yorbamedia.com. All right, Nick Santiago, President and CEO of In the Money Stocks. Nick, keep us on the right side of the trade, buddy.
Good to be back, Michael.
Yeah, I'm glad you're here.
Right now, I mean, this is a pretty good sell-off in this market. We're coming down into some interesting levels. But the one thing I want to say is, first and foremost, these markets are very oversold. So traders should not be getting bearish. I'm not saying they can't go down further. Obviously, they can. But at this stage of the game, we're overdue for some kind of a short-term bounce. And I think that's what traders should be aware of. You also have the Thanksgiving Day holiday coming up next week. That's going to be a lighter volume period. The market is closed next Thursday. And then on Friday, the market is open just for half a day. So, again, more light volume. And then we're going to come up into the, shortly into the month of December, which is notoriously seasonally a bullish month for the market. So, right now there's a lot going on out there. The fiscal cliff, the problems in the Middle East, European slowdown. I mean, it's all a perfect storm. Talk about perfect storm, Hurricane Sandy. This is a perfect storm for the markets too. So traders should, if they're going to nibble on the long side down here, cut down your share side and be more prudent.
Got it. Well put. All right. Do you have any numbers for us in regards to, support levels you're thinking about?
Yeah, right now, the S&P 500 and also the S&P Spiders are coming into an interesting support area. So I think traders should watch this 1346 level. It's a pretty big area. If we close below there significantly, then traders should watch out. There's probably more downside in the near term. But right now, this 1346 level is a pretty big test coming up.
Okay, all right, and we'll deal with the bounce when it starts happening.
Yes.
Got it. All right, how about the GLD? You wanted to talk to us about that. You were right on the money with that, weren't you?
I wanted to really speak today more so about the GDX, which is the gold miners in particular, because they're very, very oversold now. And now they're starting to actually look interesting too. But, these markets are probably all going to bounce together, but the gold miners beaten down the way they are, they're starting to look very attractive for a near-term bounce.
Okay. Is it a bounce that we'd be selling into or something we should be thinking about for a longer term?
Oh, no, nothing right now is a long-term hold. Around this $45 level for the GDX, I'm starting to get interested in it myself for a nibble here. But nothing just for a trade. There's no real reason to commit any long-term capital to this market. I mean, we don't even know what the tax implications are going to be in this market. We don't know what's going to happen with the Republicans and the Democrats. There's just so much uncertainty out there. But for a technical level, and if you could get some kind of a short-term peace treaty between the Republicans and Democrats, I think we'll see a little bit of a bounce.
Okay. All right. The NASDAQ isn't doing so well. It just broke through, let's say, on a longer-term chart like the weekly chart.
Yeah, the weekly chart of NASDAQ has sold off sharply, and it's been led by Apple, which has had just a tremendous decline. That stock's now down to 5.25 and trying to fight to even stay there. But around this 2,800 level, maybe give or take 10 points or so on the NASDAQ composite, looks like a real compelling level for a near-term bounce in the NASDAQ, even though it's already very, very oversold. But like I said, I just can't get bearish at this stage of the game. In September when I was with you on your show, I said, if they announce QE3, we'll look for a sell-off into the elections. And if Obama wins, we probably sell off even further. So far, that has happened. But right now, at this stage of the game, we're just so oversold. It's very hard to get bearish now.
Right. Well, that's okay, because as long as we're knowing what the overall trend is and where we're going to short the next rally, that's really what it's all about here. It's not necessarily trying to make it a bull market. It's trying to trade the trend. Absolutely.
Trading, if you ask me for the next 5 to 7 years, it's going to be a trader's market. Anybody that's not looking at technical levels and understanding how the technicals work really are behind the eight ball, because when you get these kind of corrections like this, you've got to know when to step in, because there's big money to be made at the turns. And when you get these big, Fed-induced inflationary rallies, you've got to know when to step out too. So it really is a trader's market.
Okay, so far, NASDAQ, S&P, and the gold miners, you're saying start to lighten up on your positions because we're going to get another shot at this after the next bounce.
Yeah, well, I think right now, we're very very close to a bounce. In fact,
Okay.
I wouldn't rule one out, at any moment. So, I think once that does happen, afterwards, you have a Christmas rally, and then we'll speak again, and we'll look at where these markets are after that. But at this stage of the game, I certainly couldn't get bearish looking at the size of this sell-off already. We've already been down. Much even further than what I thought. I thought 139, 140 was where we were going. We're, all the way now that's on the spiders. We're testing 135 now. So, we're down into near-term support levels here.
Okay, now my cycle work tells me somewhere between the 20th and the 22nd. Look out, there's something there. What's your numbers telling you, or are they price indicated right now?
Well, more so, I'm trying to put everything together with the levels, but at the end of the month, regardless, I think that the markets, could be setting up for a more significant move up now. Just a near-term bounce, because seasonality trends will tell us that we should get some kind of a bounce towards the end of the year.
Okay, got it. What's this ITB?
Yeah, the ITB is it's a good way for traders to follow the home builders without being directly in one particular home builder. The iShares Dow Jones U.S. Home Construction Index. And with all these mortgage-backed securities being bought up by the central bank, the home builders have been the best performers since October of 2011. Now they're also pulling back. I think after, a decent correction, traders should watch this $18 level on the ITB. There could be a nice little bounce play in there as well.
Do you think that it's going to resume and go back up, or is this something that's going to be just another place to short it after this bounce?
Well, I think it's going to be a trade at the moment. It could be a short probably sometime next year once 2013 hits. But right now, what I'm looking for is just trade setups for short-term bounces, just being that these markets are so oversold. But anytime you get one of the leading sectors or indexes, and the home builders have been one of the leading performers in 2012, you're going to get a bounce after a pullback. So
yeah, it's gone from 9 to 21.
Yeah, I mean, it's tremendous.
Yeah, so you're looking at 18, the range bound, 18 to 21-ish?
Yeah, pretty much.
Okay.
I don't even know if we'll get back up to 21, but I think you can get a trade from 18 to, say, 20, which is still, percentage-wise, not too shabby.
No, not too bad. All right, what about the banks, J.P. Morgan?
Well, J.P. Morgan, if you take a look at today's charts or today's action, the banks are the one sector that is sticking out like a sore thumb today. They're actually positive despite all of the negativity and everything else that's going on. JPM also tagged the 200-day moving average today. So I think there is some near-term support here for JPM. Traders that want to nibble around here for JPM, that's not a bad area. The stock could trade a little bit lower to 38. You can't rule that out. So if anybody did nibble here, you'd have to put a stop below 38 on close. But, around here, when I look at these financial stocks, they're still hanging in there. And that makes me think that, these markets are still poised for some kind of a short-term bounce around this time.
Do you see that as kind of a weak rally, maybe a dead cat bounce type, or something that's got a little more teeth to it?
We'll call it a dead cat bounce at the moment, because you just have so many problems surrounding these global markets. But either way, if you could get a bounce out of it towards the end of the year, hey, a trade's a trade, and that's all you want to be doing in this market. I don't think, at least for me, I couldn't commit long-term capital to this market at all unless it was physical gold and silver bullion. Outside of that, I think everything should just be a trade at this stage.
All right, I got it. We're going to leave it there. Before we go, though, give us, do you have any upcoming events?
Yes, we do. This coming Saturday on the 17th of November, we are hosting an In the Money Stocks Methodology webinar. We'll be teaching you everything about our cycles, our proprietary time counts, and everything that we do each and every day here in the Money Stocks. So that event is at 1 o'clock on Saturday. And traders can come over, check out the education side of the website, and you'll get all the information there.
How do they sign up for it? Give us a web address.
Yep, come on over to inthemoneystocks.com. We offer a 7-day free trial to our services, our intraday stock chat, or our nightly research, where you'll get all of our cycle work and all of our swing trade setups.
All right, sounds good. Thanks, Nick.
Thank you, Michael. Have a great day.
You too, everybody. Nick Santiago, President, CEO, InTheMoneyStocks.com. InTheMoneyStocks.com is where you find these guys. I'd get over there to that room. This guy's threaded the needle ever since we've met him back in August. All right.